generate a positive here. On the 29, you're positive. Then, before I go to there, okay, this one item, be careful. Number 30. Usually, I recommend my client don't do it. Try not to do it. That is a home business expenses. You use your home as an office, and it happened, this is the apartment, so you pay the rent, right? So you pay, say, $2,000 rent every month. As a residence rent, we cannot deduct from tax. As a residence, we cannot deduct. However, you can say, I use 25%, 30% for my business, then you can deduct, say, 25%, 30% from this rent as your business expense. But usually I say, don't get into trouble, you know. Because when I come in to do the audit, they will verify whether or not there is one exclusive space you reserve only for your business. Say, for example, your apartment is a 3-bedroom, right? And you do reserve 1 bedroom for your office. And that space must be exclusive. That really means you cannot even sit in there to check your personal email. So very, very rigid, very, very rigid. You cannot sit in that space to do any other your personal business. You cannot do any personal matters. So if you fail one requirement, you fail everything. So usually I say try not to do it. It will get you trouble.
Yeah, I have an example. Like some of the people, they are like software engineer. Like
Yeah.
they do
Yes.
some like coding for
Yes.
small company, and they got like they got like 1099, and he think to like report like his home as like part of like
Right.
business use, because he spend time at home to do this coding. Is that like?
That's okay. If you reserve that space exclusively for your business, that's fine. You can deduct it. But just be careful. When IRS come in to interview, they will not tell you what's the test. They will not tell you what's the guideline. They just ask the questions, you answer it, and when you fail, you fail. So must be careful the home use or home expenses. Before you report that, you must read the instruction very carefully. Very, very carefully, and making sure if IRS come in to audit it, your answer pass everything. Pass everything. Okay, by the way, if you come up with a positive, then you need to calculate whether or not or how much you need to pay for self-employment tax. And the formula is very complicated. I don't know why, okay? It's the number, positive number on 29. Then you, if no any home expenses, then the number in 29, you first of all, you need to, let me see. You need to time, the number is very, our number is the, if you see the numbers. Okay, if that number is positive and transfer to 1040, there's no problem. And here, you need to pay, you need to file the schedule SE. And the formula is on the schedule SE. Let me see if I have such SE here. Very complicated, it's here. Here it is. This is a SE schedule. Oh no, this is E, sorry about that. I don't have it with me. No, I don't have it with me. It's very complicated. You use that number time 0.93 something, then time another 15 something. You come up with the number, and that number you just cut a check. It's a different number from your regular income tax. So that's called self-employment. And the page 2 here, cost of goods sold. So if your business involved inventory, you need to report this. Okay, we will talk about this topic during the summer, and as I suggested, try to stay away. And the last one, part 4, is your vehicle. Here, when do you place your vehicle in the service? And this number is following from last year. You don't change this. If you use the same automobile for a few years already, you keep the same date here. And 44, of the total number of miles you drove this year, enter the number you use your vehicle for. Business, how much? How many? Commuting, be careful. For the commuting, what's the definition of commuting? That's from your home to your office. So for this distance, you cannot deduct. Okay, from your home to your office, you cannot deduct. But from your home to your client, you can deduct. From your office to your client, you can deduct. But just be careful. From your home to your office, you cannot deduct.
Even though the car is 100% used for business?
Yes. So be careful. Even the car, even the automobile is 100% you dedicate for your business. But for commuting, 1099 is the same as W2.
So if you every day go and back home, go to your office or back home in the middle of that, you visit your customer, then it's okay.
It's okay, right? So you're better off every day you find a customer in the middle way. So from your home to your customer, you deduct that. From customer to your office, you deduct that. If you can arrange this, okay, then you can fully utilize the manager. This sometimes it's very strange. And number 45, was your vehicle available for personal use? You better out say no. It's not available. I control this car. So I never use my car off duty hours. Alright. So that means 100%.
Excuse me, sorry.
Yes.
And the 44 you said the commuting, you need to find a customer. So how about a vendor?
Yes. Yes.
It's still okay.
Yes. You can arrange in the middle way, either you meet your vendors, you meet a potential customer, potential vendor, as long as you don't go to your office directly. But I see they're very tough. I see this almost once in a while, it cannot be every day. 46, do you have another vehicle available? You must say yes, right? Otherwise, how can you arrange, this car is 100% for my business, right? So number 45, number 46, they match together. They must match together. 47, do you have evidence to support? You must say yes. You must see it. When you say yes, it is, there it is. The evidence usually means, as I say, either in the computer or in the book. You write it down the day, the time, from where to where, and how many mileage, and what for. So 5 items there. Day, time, from where to where, mileages, what for. So 6 items you must keep there. Very tedious, but if you want to satisfy IRS, you better off to follow this. B, if yes, where the evidence? You cannot fooling around. Okay. Is the evidence written? You must yes. Written means in the computer, qualify as written. All right.
One question was that if you visit, like between home and the office, if you stay in or visit the Starbucks, does that consider
No.
as your
No.
vendor?
Yeah, no. If from your home to your office, you stop somewhere, say for example, coffee shop, Safeway, whatsoever, unless you meet your client or vendor there. If you just stop there, it does not count, because you can always stop somewhere. right? So too bad. You must stop somewhere to meet your client or your vendor. Otherwise, it does not come.
But like people need to buy something before they go back to the office, and the stuff will be for the business purpose. Is that fun?
No, you must meet something for your business. Let me see. Is it Hong Yong? Yes. Okay. Anyone you came in late, I miss you. Okay, so when I said at some point you may consider change your sole proprietorship to corporation. Okay, there's no answer, but you made a judgment. Some people, they set out the corporation in day one. They skip the sole proprietorship because they already foresee liability maybe somewhere down there, you know. So they start out the business as a corporation right away. So there are two type corporation. One is S corp, one is C corp. However, S corp and C corp, that is at the IRS level. Okay. For state level, corporation always register at the state level. Okay. There's only there are multiple type of corporation, but it's not S corp or C corp. They all under as a stock company or stock corporation. All right. So when you consider to set up a corporation, you register either by yourself or through CPA, through lawyer. You start out your corporation. Right now in California, it's so slow. It's like 30 days. Very slow. If you want to get quicker, you pay extra money. You pay like $450. You get it right away. So it's kind of robbery, right? It's kind of blackmail, right? You want to get it approved tomorrow, you pay more. Okay, but it is true right now. Okay. So when you approve by the state, then you report to the IRS. In order to be qualified as an S corporation, the benefit is you don't pay S corporation income tax. So you save one level income tax. So if you qualify as an S corporation, the loss or the net profit fall through to the shareholder. So you save one level income tax. That is good or bad, okay? Not necessarily good. Why? Because if it is S corporation, and throughout the year the company earned net profit, say total 200,000 net profit at S corporation. However, if the corporation determined not to distribute the dividend to shareholder, you understand? As an S corporation shareholder, you did not receive the dividend. However, you still need to pay for the tax. You understand? So it's good or bad, we don't know. Okay? Because, be careful, okay? At S corporation level, if the corporation earned net income, not necessarily it distribute dividend. So it may create a cash flow problem. If you are very rich as corporation shareholder, you are okay. But for some shareholder, they really relies on the cash dividend from S corporation in order to pay tax. Understand? Alright? So that's S corporation. However, there is a requirement. In order to be qualified as an S corporation, the maximum shareholder not more than 100 people. And husband and wife from community property state count as one. And the current tax law even extended to one family count as one. Count as one shareholder, one unit. And number two requirement, all of shareholder must be U.S. citizen or green card holder. I don't know why. Okay, this is a few example. There is a discrimination. That is a legal discrimination. And eventually they don't say discrimination, they say this is a preference. Okay. If they want to say this is legal, they don't say discrimination, but truly it is discrimination. But they say this is a tax differential. This is a tax differential. Right? So be careful if you want to organize as an S corporation, you need to make sure. Okay. I think 100 units is fine. We don't see more than 100 shareholders. That's not big deal. But big deal is you want to make sure all of your shareholders, okay, they must be either U.S. citizen or green card holder. Otherwise, you disqualify. The regular corporation is a C corporation, and a lot of reason people want to set up C. Even though they may qualify, they may be qualified as S, but they still consider to set up C. Any reason why? Do you know why? You are not big company. You are a small company.
Liability?
I think S corporation also protect your liability. So that for the liability consideration, they are the same. Eventually, once you leave sole proprietorship, almost everything here you have a certain liability protection. So if the liability is the same, why does people consider to have a C corporation instead of S? We know if you are C corporation, you pay corporation income tax, and still these people say it's okay. I don't care. I would rather at a corporation level pay one-time income tax, but I still want to go for C. Any reason why?
It's easier to go public.
That's another consideration. Maybe consider to go public IPO. Go IPO. But assuming that's too far away, you know, too remote.
Pay to yourself, you can pay a large amount on C-Corp.
That's another reason. Yes, you want to pay yourself because you don't care, right? As a corporation, doesn't matter, I need to pay tax, but as a C corporation, I would rather receive something than, you know what, because even though C corporation paid income tax, not necessarily is bad. It is not necessarily bad, right? Because the bottom line is, if the C corporation pay off everything, and then there is no too much net profit left. Understand? If you can configure it for tax planning, if you can design your C corporation pay off almost everything, and by the end of the year, by the end of the tax year, there's no too much net profit or income or taxable income left over. Not big deal, right? You understand? Because when we say income tax, you must have net income. If there is no income left, then what's big deal, right? So that is the major reason people say C corporation is okay with me, because I can control the company. I'm the major shareholder. I can almost control the decision of this corporation. As long as I can design for the whole year, by the end of the year, the bottom line of this corporation is almost zero. So there's no
There's
income.
something for the S Corp, so I still don't know what's a good benefit.
Oh, the major difference is for C corporation is for those shareholder, they don't relate too much.
The organization.
Yeah, it's more like business to business. And for the S corporation, you can work it out. It's more like a family member or very close friend. So you have an S corporation. So even we don't have IPO, even we don't want to go IPO, for those people you don't know too much each other, and you just very remotely connected, and then you would rather have a C corporation. You would rather the corporation to pay tax whatsoever, and you want to have your dividend received very, very clear cut. So as a shareholder of the C corporation, you can receive the regular salary. You just pay whatsoever you need to pay, and you receive the dividend. Okay, that's the C corporation. And here is a C corporation. If you are running a C corporation, then at the end of the year, if you issue dividend, and this is the 1099. I believe most of you receive 1099 dividend, right? If you buy stock, some of the company, even Microsoft, even Apple, once in a while, right, give you the dividends. Usually the high-tech company, they don't give you the dividend, but once in a while they will. So if you have the C corporation and you receive a regular salary, you will receive W-2, right? But if you receive the dividend, what's the what is the major characteristic of the dividend? Okay, let me put it this way. What's the difference between dividend and salary from the point of view corporation? If you are the corporation, okay, you pay out the amount, same amount to the same person. But from the point of view of the corporation, what's the difference between salary and dividend?
The money as a shareholder.
Double tax.
Yeah, salary. Let me put it this way. Salary is expenses. Let me put it this way. Salary, from the standpoint of a corporation, salary is one type of expenses. Expenses will reduce your net income. So from the standpoint of corporation, if you can control your company, you receive salary, because salary will become almost like a single layer payment. Because you pay more salary, your corporation pay less income tax, right? But if you pay dividend is double tax. Understood? So if you could control, if you're really able to control your company, you would rather not pay dividend to yourself, because dividend means your corporation pay income tax already. Whatsoever left, that's called after tax income. Your dividend is from after tax income. So dividend is really the double tax. And the salary could be single tax. Alright, so from the standpoint of a corporation, you would rather pay more on the salary instead of bonus, instead of dividend.
But you need to report the salary too. So
Oh yes, that's fine. You need to pay, but you will pay the salary, income tax, individual as an individual. But corporation can reduce corporation taxable income. So for the tax design, if you, as I said, if you can control the company, okay, most of the change you cannot control the company. But if you can control the company, and as a shareholder, you receive the same amount of money. So say $100,000, same amount of money from the corporation, you would rather receive this as a salary, because once company pays $100,000, the corporation reduce $100,000 as a net profit, so reduce corporation income tax. But if you pay $100,000 as a dividend, that really means corporate already pay its income tax already. Then you pay your dividend income, so that's become double. All right. So that's. So when the company issue the dividend, they issue this. This is called 1099-DIV. DIV. Yeah. But remember, this is not very good, because if company distribute the dividend to you, that really means this amount is being paid corporate income tax already. Whatsoever left over here, then may become your dividend. All right.
Why was there a qualified voting?
Qualified means you pay 25% straight fixed rate. Qualified usually means you are the American corporation. The corporate is set up within in the United States, and it's a common stock company. So not necessarily public, any kind of common stock is qualified.
What's the difference on the liability wise between S corp and the C corp? Any
Okay.
difference?
Liability-wise, C Corp protect better on the liability. On the liability. Say for example, if this is S corporation, if the creditor come in to sue S corporation, usually they can sue the shareholder as well. And the legal theory is because this S corporation, if the corporation did not keep formality, say for example, every year you must have annual meeting, and you must have a separate account, separate checking account. You should not have the corporate funds mixed with your personal, and also you can use a corporate checking account to pay for your personal expenses. Say for example, you have U.S. corporation. However, every month you just use a corporate checking account to pay off your mortgage. Then the creditor may argue, say, even though you have your S corporation, however you mix it together, you don't keep the formality. You don't have every year you don't have the new officer elected. You don't have the new the board member, director elected. And then even though you have S corporation, however the creditor may argue, okay, each of your shareholder will be liable for the corporate.
But if the shareholder only one between S corp and C corp, it is different.
I don't see too much difference. I don't see.
So
Right.
no matter what,
If you keep a very, very simple, you keep a very, very little number of the shareholder, I don't see the difference between S Corp and C Corp in terms of the liability. Once you have a C corporation and you have more and more shareholder coming in, then creditor might not be able to sue each single shareholder. So that is also no clear-cut answer. Yeah, but generally speaking, C corporation can provide a better protection to the shareholder. Yeah. All right, this is, yes, go ahead.
When you have this form, they have a section 1202, 1250. What is that section?
Let me see.
Like the 2B or 2C?
Oh yeah, 1250 is a small corporation. Qualified is a startup company.
So the section means the law or
Law, right. Where do you see it?
2B, 2C?
Yeah, here. Yeah, here. Very good questions, okay? Because you have on recap section 1250 again. That's the IRC, Internal Revenue Code. You can do the you can do any Google search. Okay, it's IRC 1250 section. You can see that is encouragement. Okay, incentive for the investor, for the small company investor, startup company investor. My impression is again like 2 million, 5 million. Okay, startup company, your capital is under like $5 million. And you say, for example, you put in $100,000 as your investment, and if you qualify as a 1250, and this year if you receive $10,000 as a dividend, okay, you receive 10,000. However, your investment is 100,000. That really means your capital has not been recapped yet, right? Because you pay in $100,000 to this small company. You only receive certain amount less than your investment. Each dollar you receive does not pay any tax. That's benefit. Eventually, this concept is transferred from partnership to corporation. You see the difference? Usually, generally speaking, if it is corporation, each dollar you receive as dividend, you pay tax. Doesn't matter how much money you put in. You see, if you buy any stock, right? You buy any stock, you pay in $100,000 to purchase any stock from the stock market. Doesn't matter the stock up and down. Doesn't matter. Before you sell your stock, you did not realize gain or loss. So each year, if you receive dividend, you pay dividend tax. And then right now we have a flat tax for the qualified corporation. It's 25%. Sometimes it's 28%. Doesn't matter what's your tax bracket. If you have lower tax bracket, you pay lower flat fee. All right. However, if your company is 1250, because the tax law encourage, give the incentive for the people like here in the Silicon Valley, we like to spend the money, invest money for the startup company. So this tax encourage people put the money into the small startup company. So if you receive the dividend, it's qualified as a 1250, and this amount less than your investment amount, you don't pay. Don't pay. So that's another good thing. Okay, to be very quickly, okay. Partnership right now is less and less. I only see the real estate development right now. I only see. By the way, venture capital is not belong to here anyway. Venture capital is so popular right now, but we don't see venture capital as a tax entity. We only say, oh, this is venture capital, but for tax purposes, there is no venture capital tax entity. So when we say venture capital, more likely is partnership, more likely. Because for those people coming to do business as a venture capital, they don't form any very formal business organization. So if people come in and just say, oh, this is a venture capital, for tax purposes, they may qualify as partnership. And there are 3 types partnership. The first one is called general. That really means each of the partner, they bear the full liability. Just like multiple sole proprietorship together. So that's the first time. So there's no liability protection, right? And the number 2 is the limited partnership. If you see LP, that really means there must be one or more than one general partner. And that party, that partner, will assume all of the liability. And the other partner is called limited partner. And whatever the money they contribute, there's total liability. And there's another type is called limited liability partnership, LLP. There is no general partner. Each partner, they only liable for whatsoever the money or assets they contribute. However, each state has a different regulation. In California, only the law firm or medical doctor or architect, they can form LLP. So it's very, very narrow, but it's not true in another state. All right, and LLC is very, very, very similar to partnership. LLC was derived from partnership, and more specific. It's very, very similar to LLP. Remember, I just said, right? In California, not every business can form LLP. Only very, very narrow. So for the regular business, if they want to form limited liability, it must be LLC. So each member there, we don't say shareholder, okay? We say member. Member means shareholder, right? So each member under the limited liability company, their liability only limit to whatever they contribute. That's called LLC. And right now in California, in practice, okay, people use LLC to own real estate title. All right, not necessary, but more popular. People use LLC. That really means this kind of LLC, they don't do business. They don't do import, export. They don't do R&D. They don't do any other. This type of LLC just hold the title. Sometimes there's no rental, there's no rent, there's no income. So this type of LLC is not really it's not operational. just hold the title. That's it. And the main reason is to protect the liability. Same thing. Say for example, the investor, they have 10 real estate property, for example. They have 10 houses. If 10 houses on the the personal name, if one property got a lawsuit, all of the property may become the target for the creditor. Okay, to collect the money. So when the people has more and more real estate property, they may consider to form the LLC to separate, the different real estate. And the difference here, for tax purposes, okay, we don't have time to give you the slide. For partnership, okay, same thing, there is no partnership level income tax. So partnership by itself don't pay income tax. So income or loss fall through to the partners. So the form is 1065. Okay, for partnership, doesn't matter if it's a general partnership, LP, they all file 1065. 1065. Same thing happened to LLC. LLC also file 1065. However, here's the difference, okay? If there is only one member, okay, think about this. There is no way for one partnership, right? Understand? There's no way, no such thing. No such thing. If this is one member partnership, they become a sole partnership, right? So there's no way to create one partnership, no way. However, there is way to form one member LLC in order to protect your liability. In order just to, nothing else, just to limit your liability, you can form one member LLC. And also in California, it is community property. So husband, wife considered as one member. Could be considered as one member. So here is the difference, okay? If you consider to create one member or one husband, wife LLC, you don't have to file 1065. That is benefit because save your trouble. Okay? But if you form two-member partnership, you must file 1065. That's the difference. So husband-wife in California probably is easier to form husband-wife LLC or say family LLC. You save your time. You don't file 1065. Your income, your revenue report on Schedule C or Schedule E. All right. The last thing is the nonprofit. Very quickly. Nonprofit eventually is not for business. However, is for tax saving. Is for tax saving, especially in Silicon Valley for the double income family. Say your family double income more than $300,000, and you know if you are W2, you cannot avoid it. Probably you can save money on the 401k, IRA probably, but after you use all of the limit, you have to pay tax. So for this kind of high income family, you may consider to set up your family foundation. You set up your family foundation. You can donate certain amount of money into your family foundation, and then you can deduct this on your Schedule B. Let me see. I may have Schedule B here. So, non-profit organization is for tax saving. Schedule A is your interest and the dividend income. Schedule B and Schedule A is oh, I don't have Schedule A. I don't have a Schedule A. Schedule A is itemized deduction. Okay, there's one item you can report your annual donation. Okay. By the way, when I say family foundation, it's not that easy, okay? Because people must set up the non-profit corporation at the state level. That is easy. Okay, there's no brainer. So 30 days you get approved. But more difficult is you get IRS approved. You need to get IRS approved as IRS approved this as tax exempt. It's called 501c3. You heard about it before probably. It's called 501c3 status. You will receive the number issued by IRS. If you are approved by IRS as a 501c3 organization, every year you just donate money into this corporation, then next year this corporation under your control issue you the receipt. Say you donate 30,000, 50,000, you donate to this corporation, you receive the receipt next year, and then you can deduct this number on your Schedule A, itemized. And that is another way to reduce your taxable income. And then by law, you need to use up your family foundation every year, minimum 5% of the assets for any other charitable purposes. But 5% is much less than 30% your tax bracket, right? So sometimes it's worth it to consider. So any questions so far? Due to the time limit, we need to finish. And the next time we meet is May 11th. Any questions so far? All right. So I see you May 11th. Okay.